Hello, Hamish here from mortgagesonline.co.nz. Debt to income ratios. What does it mean? The Reserve Bank have poured out an example of what it might look like in 12 months' time is when they're bringing out the tool or giving themselves the ability to do this. And they have brought an example of 6 times income, right? So how does it look? So let's say you have, this is just a very general example, 100 grand worth of income, including rent and whatnot, family income, times 6. So that's a pretty easy example, 600 grand. The banks would not be able to do more than that. If they wanted to lend you more, it would go into their speed limit. So if only 15% of their book would be allowed to break this rule, right? Kind of similar to the low deposit requirement type stuff happening now. There is going to be a distinction between investors and non-investors, right? So they could, for example, apply a rule of, say, 6.5 on one, and owner-occupier could be 5 times, or the other way around. That's the kind of thing that they are proposing will happen. How much of an impact will it have? If we look at the stats here that the Reserve Bank had kind of done some research in December 2022, what you will find is that, well, the black and the grey line here is more than 6 times debt to income. The owner-occupiers will be less affected. Probably investors are probably going to be more affected based on those stats. Today's rules, what's happening right now, if I think about that, look, the kind of with the servicing test rules and things that are there now, I don't feel like it'll have much of an impact on the market at the moment. Going forward, though, there are some key areas which will get interesting. Ideally, of course, this is probably designed so that if inflation is low, they can lower the interest rates without the property market going nuts again, right? That's probably some of the thoughts. Paying down your debt might become more fashionable, right? So the use of revolving credit home loans, offset home loans, so that you can get into the next step, whether it's a bigger property, another investment, that type of thing. Buying an investment property and even paying down investment loan might become more fashionable just so you can get to the next property, obviously. Now, cash flow strong properties will become more interesting for people, potentially. And also, some things are exempt from this, right? So construction home loans, again, exempt, just like they are with the low deposit type thing, or high deposit for investors right now. So brand new builds as well, less than 6 months old, could be more interesting again. So more support for developers, I guess, is there in these rules. Thing to remember is things like refinances, kind of moving homes like for like. These types of activities will be exempt as well. There's some exemptions there. So look, for more detail or to think about your own situation, give us a yell. I'm kind of expecting that as we run out of the 12 months before it comes in place, some people might look at their options closer and get a bit more motivated to maybe do things before the debt to income ratios come in. There might be a little bit of that activity happening later on in the year, I'm guessing. Thank you for watching, though. Hopefully that's been insightful. Hamish from mortgagesonline.co.nz.